Another rate hike has been delivered, taking the official cash rate very close to a neutral setting. But how much further will this tightening cycle take us? Our latest thoughts on the outlook for the markets, the economy, and for property values. The seventh successive RBA rate hike in the cycle was, as tipped, 25 basis points, with the RBA cognizant of the frightening level of inflation, but still applying the same logic as last month's smaller hike, including the 6-month lag between rate hikes and seeing an impact on the real economy, the likely decline in inflation next year as supply chains gradually repair, and the fact that the RBA meet monthly, unlike most other central banks. So, even though our hikes are now smaller, their frequency leaves us in the pack with matching other central banks. The RBA now estimate that a neutral rate is around 0.5% to 1% above inflation. So, a cash rate around 3.25%, assuming core inflation eventually returns to around target. But the big question for 2023 is whether neutral will be sufficient to tame inflation, with the latest high read for CPI last week and core inflation more than double target at 6.1%. From here, another 0.25% hike in December and February appears very likely, thanks to that inflation data, which will take the cash rate to 3.35%, by which time we'll have more evidence to inform the RBA if neutral is indeed high enough. Monetary policy will play its part in reducing demand until supply constraints improve, and the recent fall in the oil price is encouraging. But inflation will still be around double target in the fourth quarter before starting to fall next year. And meanwhile, fiscal policy remains unhelpfully in a structural deficit. The October federal budget was essentially just a restatement of our fiscal position after the change in government and their election promises, although it did reveal another revenue windfall, around $140 billion over 4 years. Around $90 billion of this was eaten up by inflated costs and interest rates. But while a budget surplus to help tackle inflation appears out of reach, our government debt position has improved again, with net debt to GDP down in the low 20s and only reaching 28% by 2025, suggesting our AAA credit rating is very safe. Beyond there, the structural deficits come back into focus, giving us around 3 years to lift productivity via structural reform to address the challenges ahead of an ageing population. All of this, as interest rates rise and inflation undermines asset values, is a huge challenge. But Australia remains an outperformer given our low unemployment rate, our trade surplus, and our AAA credit rating. The markets are trying to look on the bright side here and overseas, with stock markets weighing up the certainty of further rate hikes against the hope that tightening cycles are closer to topping out, and the latest corporate earnings generally beating expectations. Our bear market for stocks hasn't been nearly as dramatic as elsewhere, so, like many aspects of the last few years, not only is volatility high, but variances between and even within sectors are remarkably wide. Once again, the fate of asset values is at the mercy of just how high rates will reach, as well as which sectors, businesses, and asset classes can best cope with higher rates. And lastly, residential property values fell another 1.2% in October, so have fallen 6.5% from their peak in capital cities and 5% for regional property. Once again, there are huge variances by location, but on average, values are down 6% from their peak, having risen just over 28% during the pandemic. This downturn obviously has further to run, but is being helped by the strong jobs market and the likely pickup in net migration, as long as the RBA pause rates at neutral, which is our current forecast. And that's the market update from Leveraged.